How much do I have to put down? In this video, I will be discussing how that down payment number is determined through the underwriting process. You will learn what underwriting does not cover, what underwriting does cover, the underwriting process or steps, and how that determines how much down payment you have to put down. So first, let's start with what underwriting. What underwriting does not cover. Underwriting does not cover if this is a good deal. That's because good is a subjective word. What's good for you may be bad for somebody else, and what's bad for you may be good for somebody else. So underwriting does not tell you if this is a good investment decision or not. What underwriting does cover. It basically covers how do I get this building approved if possible? Can we approve the purchase of this building given everything that we know about it and the borrower? So that's what underwriting covers. And the way we do that is by looking at investor guidelines. And we try and manipulate different levers to try and get it to fit those guidelines. And if after trying everything, we either find something that works, but the borrower is not interested, or we're just unable to make it work for no matter how hard we try, then we just can't approve the deal. But a little bit of a side quest. So you heard me talking about investor guidelines. The way direct lenders work is we're the ones underwriting the deal. We're the ones looking at it and saying, yeah, this is a good deal. We will put our money. We will risk our money. We will lay our money on the line for this borrower, for this deal. And we get that money from a warehouse lender. So we don't use our own reserves to pay for something, to fund the deal, whether it's a refinance or a purchase. On closing day, what we do is we borrow it from the warehouse lender, and then we're on the hook for paying the interest back on that loan, on that amount of money, on a daily basis, and then we sell it to a different investor. And these investors, they buy and aggregate loans and package them up and then resell them to bigger investors, or they turn them into mortgage-backed securities, into stocks for individuals to buy, pension funds, traded on Wall Street, etc. So that's how investors work. Now we get on to the underwriting process. So today I will be analyzing or underwriting 1246 South Saltaire Avenue in Los Angeles, California. It's going for close to $2.8 million. And the first thing I have to know is the purchase price, because the purchase price determines everything else, because they're usually phrased as a percentage of the purchase price. For example, the down payment is X percent of the purchase price. Property taxes are X percent of the purchase price. So it's very important to know the purchase price. The next thing we have to know is the gross rents. So if we can see here, there are 8 units, and they're earning roughly about $2,000 per unit, or a total of $16,000. But we have 1 unit vacant, and as you can see, not every unit is hitting $2,000 here. Some more, some a little bit less. With a bank like Chase that does their own in-house commercial multifamily lending, or Fannie Mae, Freddie Mac, small SBL, I forget what the SB stands for. but the small balance loan, that's what the B stands for, the small balance loan, because it's usually less than a few $1,000,000. So on those loans, they look at net operating income, which is they look at all the gross rents. They take out all the expenses that the landlord or owner has to deal with, which includes not only property taxes and insurance, but also trash pickup, water, gas, and electric for the common areas, property management fees, legal fees, maintenance fees. All those things they look at, and then they deduct it to figure out a yearly average for the net operating income, and then they see if that covers the debt, usually by a factor of 1.2. That means if you were to look at all the expenses, or rather, if you were to look at the mortgage payments, the principal and interest payments, and multiply it by 1.2, that's what the NOI has to equal. That's what the net operating income has to equal. As a DSCR lender on 5 to 8 unit buildings, commercial buildings, I do not do that. I look at the gross rents, and my minimum ratio is 1 time times the property taxes, insurance, the monthly property taxes, monthly insurance, the monthly principal and interest payments, and HOA fees, if any. I don't care about anything else as a DSCR lender. As long as the gross rents cover the mortgage payments plus the property taxes and insurance, this loan is approved. Now, if you get more than that, if your rents cover more than the PITI payments, the property, the principal payments, the insurance, the taxes, and the interest payments, then I give you a bonus in the form of lower rents. So let's go ahead and analyze this and see how to make this property work. So I don't even know if this will work, but we will see how to make it work. So we will go 1993 plus 1982 plus 1490, 1996, 2250, 2150, 2250. So that's $14,111. That's actual rents. But with the DSCR lender, and here's the benefit of a DSCR lender or a DSCR loan over a Freddie Mac or a Fannie Mae small balance loan or even a Chase Bank loan, which has incredible interest rates, by the way, in the mid to high fives right now, I believe. So you can see this has 1 vacant unit. So if we go and do 7 out of 8 units occupied, we have an occupancy value of 87.5. That's important because on commercial buildings, when borrowing from, when doing a SBL loan, a Freddie Mac or a Fannie Mae small balance loan, or a Chase Bank or a Western Union or Bank of America private bank loan, they require at least a 90% occupancy. Well, 90 means you got to get 9 out of 10 units filled. So on a 10-unit building, if you have 1 vacancy, that's okay. But on an 8-unit building, if you have 1 vacancy, 7 divided by 8, you're below 90% occupancy. So that means you have to have 100% occupancy. With the DSCR loan, that we do, the maximum vacancies that we allow is up to 2 units, and that's from 5 to 8. So let's say you have a 5-unit building and you have 2 vacancies. So that's 60% occupancy or a 40% vacancy rate. And on a 8-unit building, if you have 1 out of 8, you have a 0.125 percent or 12.5% vacancy rate. So we can do this loan even when the banks cannot. That's the good thing. So the other way we do this is that we can also use market rents to qualify for the vacant units. So the market rent here, the projected rent, is based on market rents. So we're looking at $2,400, and if I were to add that to the $1,411 that we originally came up with, that's total gross projected gross rents of $16,511 a month. But I'm going to be conservative because some of our investors who we sell this loan to do not allow us to use the full market rent. They want us to use only 75% of the market rent on a vacant unit. So that means times 0.75, we can only use $1,800. And that means our actual gross rents for the calculating of DSCR purposes is less than $16,000, slightly less, $15,911. That's what it is. So let's go ahead and enter that into my calculator. Now, this is a spreadsheet that I made in order to analyze properties as an investor. But again, as an underwriter, my job is not to analyze this property as an investor. It is to analyze it as an underwriter. But this spreadsheet has certain tools that I built in to make it easy to see if it's actually worth it. So here's the purchase price. I'm setting that at $2.8 million, $2.795 million. Property taxes are at 1.25%. In LA, they range anywhere from 1.15 to 1.25%. I calculate it at the higher number because if actual property taxes are lower, well, then we know this qualifies. But if I were to use a lesser number just to try to get this approved and push to get it approved, but then it turns out property taxes are actually higher, well, then now I've got to go back and rework this from scratch. Or the deal might die, especially on a purchase when there's contingency deadlines. If the deal does not close on time, sometimes the seller just might back out and the buyer loses the deal and they never come back to us. So also on a 5+ unit building, the minimum down payment is 25%. Let's see, what else? I'm going to leave this as fully amortized, meaning that your monthly payments includes payments towards the principal and interest. Projected ARV price doesn't really matter, but let's just make that equal. And 8 units, so 15,911 divided by 12. Oh, I keep doing that. Why do I keep doing that? 11 divided by 8. 1988.88. 1988. So that's $1,900 or $1,988.88, or roughly $15,911 a month. Property taxes. So this is 1.25% of the purchase price, $34,000, or $35,000 a year. Let's say $36,000 just to keep it simple. Over 12 months, that means you're paying $3,000 a month in property taxes. Hazard insurance. Last time I did a deal like this, which was about a month ago, hazard insurance or landlord insurance was going for about $1,100 per unit. On an 8-unit property, that would make it about $8,800 for landlord insurance. And right here, you can see Let me scroll this up so you can see it so my head's not blocking it. Property taxes, $35,000 a year, and hazard insurance, $8,800 a year. And here's the DSCR ratio at 0.82. So here's my rate sheet, and let's see, minimum DSCR ratio is a 1.0. So if the DSCR ratio is smaller or less than 1, we can't do the deal. It needs to be at least 1.0 in order to pull up pricing. Now we use pricing engines, but to protect now we use pricing engines, but to protect our investors' names against other lenders, not even from you. You guys can try to go to them directly. They would not even lend to you directly because they're correspondent banks and they do wholesale lines. So they prefer to lend through direct lenders such as myself. But to protect it from other brokers and other lenders over whom I have a competitive advantage, I will not reveal them in this video. But I did go through and I noted their pricing here. What you see here is the down payment, the DSCR ratio at that down payment, and what the interest rate would be, assuming we got a 1.0 or 1.1 or 1.15 DSCR ratio, what that interest rate would look like, as well as the pricing. And you'll see that the pricing is weird. It's noted as decimal: 100.175, 100.250, 99.513, 99.750. What does that mean? What that means is when you qualify for a loan, there's a baseline interest rate determined by your credit score, your down payment, by your DSCR ratio, etc. And if the price is quoted as being over 100, then you receive money for taking that interest rate. If your number is below 100, then you actually have to pay to get that interest rate. You're prepaying interest, or you're receiving prepaid interest in the case of a rebate or where the price is over 100 points. So 100.25 means that you're getting a quarter point or a quarter of 1% of the loan amount as credit towards closing costs in order to take an interest rate of 6.875. But how is it that here you're having to pay to get an interest rate? You're having to pay half a point or 0.5% of the loan amount in order to get an 8.125%, versus here you're getting money in order to take a 6.875%, a much lower interest rate. And that has to do with the DSCR ratio here. So, like I mentioned, if you have a DSCR ratio of 1, if you have a higher than 1 DSCR ratio, that's obviously better. And they reward you for that by giving you a better interest rate. And now we will discuss how to get that higher DSCR ratio. So at 1.0, you are at an 8.25. But let's say we want this 5.75% interest rate, right? So let's go here and punch in 5.75%. And our DSCR ratio is a 1. Even at that much lower interest rate, it jumped up from 0.88 to 1.0. So how do we get that interest rate or that DSCR ratio to 1.1 so that we can actually qualify for this? So the way we do that is by increasing the down payment or lowering the loan amount. because a smaller loan amount means lower monthly payments relative to the gross rents. That means that gap between the gross rents and the monthly payments is much bigger, which means you have a bigger DSCR ratio. And even then, you're still at 1.06. So let's say 35%. Now you're at a 1.12, but in order to qualify for this, you need a 1.1. So you would need to put down 35% or $978,000 as your down payment. And when you raise this up again, $978,000 right there. So, but I also want you to note that in order to get that interest rate at that down payment, 35% down, you got to pay 5 points. This is 95, which is 5 points, or 5, the number 5 less than 100. So 5 points less, which means a 5% of the loan amount is what you would have to pay in order to get that interest rate. So let's see what that actually looks like. So we had a loan amount of 2795, 35%, 65% LTV, 35% down. That means your loan amount is 1.8 million. Origination fee 2%. Discount points, let's say 5, and this is 95. And this is a commercial building, and the loan amount is more than 1.5 million, so that means your appraisal cost, we have to do 2 appraisals, and appraisals for commercial buildings are roughly $2,500 per appraisal. And when the loan amount is greater than 1.5 million, the investor requires us to do 2 appraisals to make sure that that building is worth it from 2 independent sources. So at 35% down, 5.75%, 1 month prepaid, and that's just the prepaids are basically the daily interest and principal payments from the day the loan closes until the start of the next month. So if your loan closes October 15th, you're paying about 16 days of prepaid interest. And the way we would do that is 0.5, so you'd be paying about $5,300 in prepaid interest and principal. I like to leave it at 1 because that's usually the maximum we would charge on a DSCR loan. So that means you would have to bring in $1.127 million as your down payment, or 35% down. Let's see if there's a better way to do this. Well, actually, there is. What if you got the seller, and this is the investor side of me talking, there's a tangent, it's not actually relevant to this video, but I can't help it. So let's say instead of negotiating the price down from 2.795 to 2.695, if you stay there, your cash to close is about $40,000 less, $30,000 less. No, let's see. That's what? 50? 40. It's $40,000 less, right? So let's say we leave it at 2.795 million, and we get about 5 points or $90,000 in credit from the seller. Now your cash to close is $1,036,000. which is almost $100,000 less than it would be if you actually got them to lower the sales price and you just said, no, I don't want seller credits and I refuse to buy points. All right, investor hat off. So let's see here. Next would be gross rents, operating expenses, down payment, interest rate. So this is how we determine the down payment. This is the least bad situation. And if you don't believe me, here's something we can do. Let's say we go for this interest rate right here, which is a 6.875 at a 1.15 ratio. Okay? So 6.875, I believe, or was it 6.75? 6.875. So let's see what the DSCR ratio is now. The DSCR ratio at 6.875 and 35% down is 1.02. And we need a 1.15%, or we need a 1.15 DSCR ratio to get this. And who would do that? Why would they do that? Why would they choose to put a bigger down payment in order, or why would they refuse to buy down interest rates? Because to them, it's throwing money away. They would rather put money towards equity. So let's see what 40% down looks like at 6.875. Your DSCR ratio is 1.09. Well, what about at 45% down? Now your down payment is 1.257 million versus your down payment being $1,036,000. So you have paid $200,000 extra in order to get a 6.875% interest rate, just in order to prevent throwing away money. And I do those quotes not because they're wrong. They're not wrong, and they're not right. It's only throwing away money if you don't get back anything in return. It's not throwing away money if you feel you're getting back something in return. And that's called the subjective value, the theory of subjective value. What's trash to somebody is worth it to somebody else. So having a 5.875 or a 5.75% interest rate is absolutely worth $100,000 because their down payment's only 35%. But for this person, they would rather put 10% more down or 45% down, and a difference of, let's see, 1.257 versus 1.036. So that's $121,000 more, right? $121,000 more. And their DSCR ratio is at a 1.16. And at that, they qualify for this. Now, they can buy it down still for roughly 1 point, for 0.9 points, for 0.875 points, they can get a 6.625%. So let's assume they do that. 0.875, 98.75. Let's leave that at 0. And what was the down payment here? 45% down. That's a 55% LTV. The loan amount is still greater than 1.5, so you got to have 2 appraisals. But now look at it. Your cash to close is 1.3 million, almost $300,000 more than if you had just decided, let me do the 65% LTV. Let me do the 5 points. Let me purchase 5 points of 5 points for the discount points. And hell, I can even get the seller to pay for it or partially pay for it. Let's say they only do 3 points. Well, you're still coming in cheaper, and your cash to close is you're saving $300,000 there. But as a loan officer, I would present both and let the borrower decide what do they prefer, because I don't judge. As an investor, I would absolutely buy points, especially if I can get the seller to pay for it. But I'm not going to judge because I've had some very smart borrowers look at it and go, yeah, $300,000, I get that as equity, the loan amount smaller, I can refinance in a year or two without feeling like I'm obligated to recoup that cost that I spent on discount points. Absolutely makes sense. It's totally logical. So let's see what else can we do here to make this work better. So let's see, what if we don't want to put that much money down? Let's say we stay at 30% down and we want that same interest rate. We still want a lower interest rate. So if we go interest only, now you're not having to make payments on the principal. You're only making interest only payments. And at 30% down, look at this. You're at 1.07, right? But that's at a 6.875% interest rate. At a 6.875% interest rate. If you go to a 5.75% interest rate, we're at 1.22. We're at 1.22. So now I can get away with even less money down. So I can go 70% LTV. I can still do, I can still purchase 5 points for the discount points, have the seller cover it. For the sake of numbers, let's just leave that blank or leave it at 0. That means the seller is not paying for those discount points. You, the borrower, are paying for those discount points. Let's see, interest only payments. Now your monthly payments are $9,300 a month. That's going only towards interest, not towards equity. If you only care about cash flow, absolutely makes sense to do this. If you care about equity and appreciation, it does not make sense to do this. But for people who are interested in closing, now your cash to close is less than $1 million. Less than $1 million. In order to get that at Chase, that same interest rate, you're going to have to get a 1.2 DSCR ratio, or let's be fairly generous and say you need a 1.2 DSCR ratio. And if we get the seller to pay for it, your cash to close is $900,000, $897,980. But let's be generous. Let's say you're Chase Bank and you got qualified based off of NOI, NOI, and you need a 1.2 DSCR ratio, right? So I gotta put, and their interest rate's going to be the same, but it's going to be fully amortized. And they're going to base it after all the expenses on the property. So down payment, 30%. Let's see what that looks like here. They're 1.06 DSCR ratio, but this DSCR ratio is based off of gross rents, not NOI. So let's say what 50% looks like, okay? Now you're at a 1.35, okay? So your net operating income, your first year, is projected at $118,900. So let's just say $119,000. $119,000. Or let me That's my net operating income, right? 119,000 times 1.2 divided by 12 means 11,900. No, I did that backwards. 119,000 divided by 1.2 is 99,000 divided by 12. That means my monthly payments cannot exceed $8,263 a month, my principal and interest payments. So let's see how we can get that. Monthly payments, let's see, 50. So that's 8,100, 8,200. So technically, at Chase or another multifamily lender known for these types of properties that have incredible interest rates and great reputations, 52% would be too much, 50% would be too much, 50.5, 82.36, 82.63. So your down payment is 50.5%. In terms of cash to close, and there are 0 discount points, 0 seller credits, and maybe 0 origination fee. Let's just be generous. They might charge half a point to 1 point in origination fees, but let's just say they don't. Okay? And even the appraisal, I believe they would cover the appraisals. So that sounds great, right? They're not charging you anything in terms of cost of the loans other than like processing fee, underwriting fees, credit reports, title and settlements, etc. Just the bare minimum, right? You still have to bring $1.4 million to the closing table. Now, yeah, that's going all towards equity. Totally get that. But if you care about minimizing your down payment, cash out of pocket, if you look at all cash leaving your bank account as an expense, regardless whether it's going to this source or this source, to you it doesn't matter. You just see it leaving your bank account. Well, with that type of loan, you got to spend $1.4 million versus an interest-only loan, 5 points, 5 points seller credits, 2 points origination fee, $5,000 for the 2 appraisals, and hell, let's even say 0 seller credits. Now, you only have to spend less than $1 million, $5,000 less than $1 million, $995,000. So these are the options. And again, I slid on the investor side because, hey, I'm an investor. That's just the way my mind works. But from an underwriting standpoint, this is what one of the options that I would present to a borrower who came to me and said, can I qualify for this loan? And this is the way I would make it qualify. I would present all these options and I would say, which one do you like best? Here is the lowest down payment option. Here's the lowest cash out of pocket option. And here is, the best thing we can do for you with the DSCR loan, 6.875, 0, and this was what? 0.875, 99.125, I believe. $55. And this was monthly payments. So here we are looking at $1.3 million out of pocket versus Chase's 1.4. So I would present these 2 offers to them so that they got a full range. 6.625. Right? Rate sheet says 6.625. Yeah. So I would present this to my borrower and say, hey, this is less down, than you would with Fannie Mae, Freddie Mac small balance loan. This is less than a Chase Bank loan in terms of down payment. This is less than Bank of America private bank or JP Morgan or Western, not Western Union, Wells Fargo loan, commercial loan. In terms of down payment, less money out of pocket to get possession of this building, and you would still be cash flowing every month at a pretty decent rate. You would be cash flowing roughly 1.2 DSCR. Your DSCR ratio would be roughly 1.2. This is at 1.18, still a little bit short. So let's say 50%. There it is, 1.26. So this would have to be 50%. 1.457. About 60 grand more than a Chase Bank loan. At this point, it might not be worth it because 5% less is going towards equity. Oh, and because that loan amount is less than 1.5, your appraisal cost would be $2,500. So that's how I underwrite a loan, and that's how down payments are determined when underwriting a building, because there is the minimum amount per the rate sheet. There's a minimum of 25% down, but just because that's the minimum doesn't mean that's what you're going to pay. There are still all these other guidelines that we've got to meet in order to be able to sell the loan. Think of it like you owned a McDonald's, right? And somebody comes in and says they want McDonald's was, they're the one your way right away, right? No, that's Burger King. So let's say you own a Burger King, and someone comes in and says they want a Big Mac, but no meat inside, and you're like, sorry, dude, all our Big Macs come with burgers with meat. It's a burger. Well, you just lost that customer, and now you have no one to sell to. On the other hand, somebody comes to you and says they want a Big Mac with no meat inside, and you notice all your customers want that, or your highest paying customers want that. Well, if you want to sell to them, you're going to cater your product to them. And so if I want to sell to these investors, I have to cater my loans to them. Otherwise, I'm stuck with being unable to repay my warehouse lender. And that's the way direct lending works. And yeah, that's pretty much it. That's probably not the best way to end a video, but I don't know where else to go from here. I hope it was helpful.